Hello class, welcome to Group 1's mini case study on Chapter 6's New Economy Transport A and B. For today's agenda, we will be talking about the New Economy Transport A, the costs associated with that section of the case, and we will present our analysis along with our calculations. Then we will move on and do the same thing for the New Economy Transport B section, its proposal cost, the Conan Doyle cost, and the 20-year NPV, along with our analysis, and then we will end off with concluding statements. The New Economy Transport Company, also known as NETCO, was formed in 1959 to carry cargo and passengers between the Pacific Northwest and Alaska. By 2018, its fleet had grown to 4 vessels, including a small dry cargo vessel called the Vital Spark. The Vital Spark is 25 years old and badly in need of an overhaul. Peter Handy, which is the finance director, has just been presented with a proposal that would require the following expenses. Overhaul engine and generators would cost $340,000, replacing radar and other electronic equipment at $75,000, repairs to hull and superstructure $310,000, painting and other repairs at $95,000, all totaling to $820,000. Mr. Handy believes that all of these outlays could be written off immediately for tax purposes. NETCO's chief engineer, McPhail, estimates the post-overhaul operating costs as follows. The fuel at $450,000, labor and benefits at $480,000, maintenance at $141,000, other costs $110,000, totaling $1,181,000. These costs generally increase with inflation, which is forecasted at 2.5% a year. The Vital Spark is carried on NETCO's books at a net depreciated value of only $100,000, but could probably be sold as is, along with an extensive inventory of spare parts for $200,000. The book value of the spare parts inventory is $40,000. Sale of the Vital Spark would generate an immediate tax liability on the difference between sale price and book value. The chief engineer also suggests installation of a brand new engine and control system, which would cost an extra $600,000. This additional equipment would not substantially improve the Vital Spark's performance, but would result in the following reduced annual fuel, labor, and maintenance costs. Fuel would then be $400,000, labor and benefits at $405,000, maintenance $105,000, other $110,000, all resulting in $1,020,000. Moving on to describe additional particulars, the overhaul of the Vital Spark would take it out of service for several months. The overhauled vessel would resume commercial service next year. Based on experience, Mr. Handy believes that it would generate revenues of $1.4 million next year, increasing with inflation thereafter. But the Vital Spark cannot continue forever. Even if it is overhauled, the useful life is probably no more than 10-12 years at the most. Its salvage value when finally taken out of service will be trivial. NETCO is a conservatively financed firm and a mature business. It normally evaluates capital investments using 11% cost of capital, which is a nominal rate, not a real rate, and NETCO's tax rate is 21%. Here we have the requirements for the first section of the New Economy Transport A. Calculate the NPV of the proposed overhaul of the Vital Spark with and without the new engine and control system. To do the calculation, you will have to prepare a spreadsheet table showing all costs after taxes over the vessel's remaining economic life. Take special care with your assumptions about depreciation, tax shields, and inflation. Here is step 1A, where we enter the values into the Excel spreadsheet. We are finding the NPV of overhaul without a new engine and control system for 10 and 12 years. The investment is $820,000, which was given. The sale of equipment and inventory is $60,000, which is the sale price less the book value of the Vital Spark. The depreciation is immediate, so that is the initial investment. Post-overhaul cost and annual revenue were given. The tax rate is 21%, the cost of capital at a nominal rate is 11%, and the inflation every year is 2.5%.
The initial investment, totaling $820,000, represents an immediate cash outflow in year 0. The sale of assets, which occurs in either year 10 or year 12, depending upon useful life, generates a taxable transaction of $60,000 in the year of sale. The taxable amount of $60,000 represents the difference between the sale price of $200,000 and the book values of $100,000 and $40,000 for Vital Spark and the spare parts inventory, respectively. A tax totaling $12,600 is generated by applying the stated tax rate of 21% to the sale of assets, which results in a net cash flow from capital investment of the sale totaling $47,400. In year zero, there are no revenues or additional costs associated with the proposal. The finance director believes the investment can be depreciated immediately. Pre-tax profit is calculated by subtracting other costs and depreciation from revenues. In year zero, the lack of any revenue results in a quote-unquote negative pre-tax profit of $820,000. The tax is calculated by multiplying the stated tax rate of 21% by the pre-tax profit. The profit after tax of negative $647,800 is calculated by subtracting the tax from the pre-tax profit. Finally, operating cash flow is determined by adding depreciation and the profit after tax. Year one revenues are expected to be $1.4 million, and post-overhaul operating costs, referred to as other costs in the spreadsheet, are expected to total $1,181,000. There is no further depreciation since the investment would be fully expensed immediately. Pre-tax profit totaling $219,000 is calculated by subtracting other costs and depreciation from revenue. Tax of $45,990 is calculated by multiplying the tax rate of 21% by the pre-tax profit. Profit after tax totaling $173,010 is calculated by subtracting the tax from the pre-tax profit. Year one operating cash flow is calculated by adding back depreciation, which is zero here on out, and the profit after tax. Beginning year two and onward, both revenues and other costs are expected to grow at the inflation rate of 2.5%. Year two revenues are calculated by multiplying year one revenues by 1.025, which is 1 plus the inflation rate of 2.5%. Revenues for future years are calculated in the same manner, by multiplying the prior year's revenue by 1 plus the inflation rate of 2.5%. Other costs are treated in the same manner. Year two other costs are calculated by multiplying year one other costs by 1 plus the inflation rate of 2.5%. The same process is applied to determine the other costs for future years, by multiplying the prior year's other costs by 1 plus the inflation rate of 2.5%. The process of calculating operating cash flow for years 2 through 10 or years 2 through 12 is the same as both year 0 and year 1. Pre-tax profit is determined by subtracting other costs and depreciation from revenues. Tax is calculated by multiplying the tax rate of 21% by the pre-tax profit. Profit after tax is the difference between pre-tax profit and the tax. Lastly, operating cash flow is the sum of depreciation and profit after tax. Total project cash flow is the sum of cash flow from capital investment and the operating cash flow. The total project cash flows for each year must be discounted to present values. The discount factor is determined by the following equation: 1 divided by 1 plus the discount rate, which in this case is 11%, raised to the number of periods. Discounted cash flows are calculated by multiplying the total project cash flow by the discount factor. Net present value is the sum of all discounted cash flows for the project. The net present values for projects with useful lives of 10 years and 12 years are $486,688.95 and $618,699.22 respectively.
Now we are trying to find the NPV of the overhaul with a new engine and control system for 10 and 12 years. The investment changes, the sale of equipment stays the same, the depreciation is equal to the initial investment, Post-overhaul changes, the annual revenue stays the same, tax rate at 21%, the cost of capital at a nominal rate stays at 11%, and the cost of inflation per year is still the same as 2.5%.
As noted, the installation of a new engine and control system increases the total initial investment to $1,420,000. This investment represents an immediate cash outflow in year 0. The sale of assets, which occurs in either year 10 or 12, will generate a taxable transaction of $60,000 in the year of sale. The taxable amount of $60,000 represents the difference between the sale price of $200,000 and the book values of $100,000 and $40,000 for VitalSpark and the spare parts inventory, respectively. The tax on sale is generated by applying the stated tax rate of 21% to the sale of assets. This results in a net cash flow from capital investment of the sale totaling $47,400. In year 0, there are no revenues or additional costs associated with the proposal. Additionally, the investment is expected to be depreciated in full immediately. Pre-tax profit of negative $1,420,000 is calculated by subtracting other costs and depreciation from revenues. The tax is calculated by multiplying the stated tax rate of 21% by the pre-tax profit. The profit after tax of negative $1,121,800 is calculated by subtracting the tax from the pre-tax profit. The operating cash flow is determined by adding depreciation and the profit after tax. Year 1 revenues are expected to remain $1.4 million, and post-overhaul operating costs are expected to decrease to $1,020,000. Pre-tax profit totaling $380,000 is calculated by subtracting other costs and depreciation from revenue. Tax of $79,800 is calculated by multiplying the tax rate of 21% by the pre-tax profit. Profit after tax totaling $300,200 is calculated by subtracting the tax from the pre-tax profit. Year 1 operating cash flow is calculated by adding back depreciation, which is 0 for the remainder of the project, and the profit after tax. Beginning year 2 and onward, both revenues and other costs are expected to grow at the inflation rate of 2.5%. Year 2 revenues are calculated by multiplying year 1 sales by 1.025, which is 1 plus the inflation rate of 2.5%. Revenues for future years are calculated in the same manner, by multiplying the prior year's revenue by 1 plus the inflation rate of 2.5%. Other costs are treated in the same manner. Year 2 other costs are calculated by multiplying year 1 other costs by 1 plus the inflation rate of 2.5%. The same process is applied to determine the other costs for future years, by multiplying the prior year's other costs by 1 plus the inflation rate of 2.5%. The process of calculating operating cash flow for years 2 through 10, or years 2 through 12, is the same as year 0 and year 1. Pre-tax profit is determined by subtracting other costs and depreciation from revenues. Tax is calculated by multiplying the tax rate of 21% by the pre-tax profit. Profit after tax is the difference between pre-tax profit and the tax. Lastly, operating cash flow is the sum of depreciation and profit after tax. Total project cash flow is the sum of cash flow from capital investment and the operating cash flow. The total project cash flows for each year must be discounted back to present values. The discount factor is calculated by 1 divided by 1 plus the discount rate of 11% in this case, raised to the number of periods. Discounted cash flows are calculated by multiplying the total project cash flow by the discount factor. Net present value is the sum of all discounted cash flows for the project. The net present values for the project with useful lives of 10 years and 12 years are $834,447.22 and $1,065,817.99 respectively. As you can see, the net present values for the projects including the installation of the new engine and control system are greater than those without these enhancements.
Moving forward to the New Economy Transport B, there's no question that the Vital Spark needs an overhaul soon. Mr. Handy feels it's unwise to proceed without considering a purchase of a new vessel. Conan Doyle, which is a Wisconsin shipyard, has approached Netco with the design incorporating Court Nozzle, which is an automated navigation and power control system, which makes the accommodations much more comfortable for the crew. Estimated annual operating costs of the new vessel are on the following slide. Estimated annual operating costs for fuel are $380,000, labor and benefits are $330,000, maintenance at $70,000, other costs at $105,000, totaling $885,000. The crew will require additional training to handle the new vessel's more complex and sophisticated equipment at $50,000 next year. The estimated operating costs for the new vessel assume that it would be operated in the same way as a Vital Spark. However, the vessel should be able to handle a larger load, which could generate additional revenues as much as $100,000 per year for out-of-pocket costs. Moreover, a new vessel would have a useful service life of 20 years or more. Conan Doyle offered the new vessel for a fixed price of $3 million, payable half immediate and half on the delivery next year. So, Mr. Handy stepped out on the foredeck of the Vital Spark as she chugged down the Cook Inlet. "A old rusty tub," he muttered, "but she's never let us down. I'll bet we could keep her going until next year while Conan Doyle are building her replacement. We could use up the spare parts to keep her going. We might even be able to sell or scrap her for book value when her replacement arrives. But how do I compare the NPV of a new ship with the old Vital Spark? Sure, I could run a 20-year NPV spreadsheet, but I don't have a clue how the replacement will be used by the end of that time. Maybe I could compare the overall cost of overhauling and operating the Vital Spark to the cost of buying and operating the proposed replacement." The New Economy Transport B requirements are to calculate and compare the equivalent annual costs of A. Overhauling and operating the Vital Spark for 12 more years, and B. Buying and operating the proposed replacement vessel for 20 years. What should Mr. Handy do if the replacement's annual costs are the same or lower?
Now we're going to calculate the net present value of proposed overhaul without the new engine for 12 years useful life. The investment amount would be $820,000. The sales of equipment and inventory, which is the sales price less the book value, it would be $60,000. The depreciation would be the same as the initial investment amount. The amount for post-overhaul costs would be $1,181,000. The annual revenue would be $1.4 million. The tax rate is at 21%. The cost of capital at a nominal rate would be 11%, and the inflation of 2.5%.
In year 0, also the initial state of the investment, we have a negative cash flow from investments in fixed assets for negative $820,000, with no revenues and no other costs at this point. The full depreciation expense will be the only expense. At year 0, we will receive a tax revenue of $647,800. And the net operating cash flow will be the depreciation expense plus profit after tax at $172,200. The total project flow at year 0 will be the cash flow from project investments plus the net operating cash flow. The discount factor changes by year. At year 0, it is at 1.00. So the discounted cash flow for the year 0 is $647,800. Starting in year 1, there will not be any cash flow from capital investment for year 12. The revenues and other costs will be growing at the rate of inflation for 2.5%, starting at $1.4 million and $1.181 million respectively since year one. The pre-tax profit will be the revenues minus the other costs and the depreciation expense. Applies the formula to get to the net operating cash flow and discounted flow for year 1 to 12. The net present value of the proposed overhaul of Vita Spark without the new engine and control system for 12 years of useful life. It is the sum of the discounted cash flow from year 0 through year 12 at $618, $699, and 22 cents. The annuity factor of 12 years at 11% is 6.4924. We have the EAC at 95 to 96 and 56 cents, calculated by dividing net present value by the annuity factor. Using the same calculation model from the last example, we can easily calculate the net present value of overhauling and operating for 12 years with the engine. Since the other factors remains the same, we just need to adjust the initial cash flow amounts to negative $1.42 million. The net present value is now at $1,065,818. The annuity factor remains the same as 6.4924. We now have a new EAC at $164 and $165. Calculated from the same formula, dividing net present value by the annuity factor. For the option of buying and operating, the Vita Spark proposed to purchase a replacement vessel for 20 years. The cost of the new vessel is $3 million. The payable amount is split into two parts. The first part is due immediately, and the second part is due in year one. There is no taxable event from the sale. Spare parts inventory is consumed and kept in Vita Spark for operational until the new vessel is ready in year one. One-time training expense related to this replacement cost $50,000 incurred in year one. The inflation rates and the cost of capital are at 2.5% and 11% respectively. The annual revenue is expected to be at $1.5 million. Input the $1.5 million cash flow from investments in fixed assets for year 0 and the other half in year 1. Enter revenue, other costs, and depreciation expense as $1.5 million, $935,000, and $3 million respectively. Note that the cost of training for $50,000 only incurred in year 1. So moving forward in year 2 and the following years, the training cost will be dropped from the operating cost. The same calculations from the last two examples will be used in here to get to the discounted cash flow with the incremental cost of 2.5 inflation rate and the 11% discount rate. The sum of all discounted cash flow will be the net present value of the annual cost of buying and operating a replacement vessel for 20 years of useful life. The net present value is now at $2.2 million. The annuity factor of 20 years at 11% is 7.9633. The ECA we have right now is $280 and $635.
Suppose the replacement's equivalent annual costs are higher than the Vital Sparks. What additional information should Mr. Handy seek in this case? The equivalent annual costs are the annual costs related to operating, owning, and maintaining the asset. This cost is mostly used by the company for making decisions related to capital budgeting. It can be used to help in comparing the costs of different projects that have different lifespans. If the replacement's equivalent annual costs are higher than the Vital Sparks, Mr. Handy should seek more information to help with a capital budgeting decision. Some of the additional information to help with the decision should include the potential scrap value of the Vital Spark that could benefit the replacement and the tax rates to compare the after-tax cash flows. Other relevant information would be the incremental revenue, incremental depreciation, and other incremental expenses to help determine the incremental cash flows. Incremental analysis is a good method to determine replacement decisions. To get this information, Mr. Handy should seek data for revenues, taxes, depreciation method, and depreciation expenses to help determine the incremental cash flows. Given the information that the replacement's equivalent annual costs are higher, Mr. Handy should choose to overhaul and operate the Vital Spark for 12 more years.